The life health industry has demonstrated the ability to manage the business very well during slow economic growth, but it's still struggling to find top-line growth in its existing U.S. markets. And of course, the market is having trouble shaking many of the obstacles that it has dealt with in recent years, including changing customer behavior, regulatory initiatives, and the ever-present low interest rate environment. Still, the U.S. economy is expected to keep growing at a steady pace in 2015, which should allow insurers to competitively position themselves and further influence positive earnings.
Direct premiums written within the U.S. Life health industry declined by roughly 1% in 2014 compared to a decrease of about 5% in 2013. One thing to note is that Humana Insurance Company had changed their filing status in 2014. So had Humana been incorporated in the U.S. industry results that we reported, you have seen that the premiums had actually increased by 2% for the year. In relation to the health lines of business, both individual and group health business segments reported a decline in 2014. Group health premiums were down about 4%. The individual health was down about 14% in 2014. Now, again, we've mentioned about Humana not being incorporated in our industry results. Had their $22 billion of premium been incorporated, you have seen that both group and individual health insurance premium would have gone up slightly for the year. The increase in premium within the health market for 2014 was attributed to the rate increases that were applied in anticipation of the Affordable Care Act being implemented in 2014 and the anticipated margin compression associated with that. Surprisingly, group and individual life insurance has shown premium growth for the last 5 years, including 2% in 2014. And I'm saying surprisingly because of the lower interest rate environment, rate increases, higher financing costs, in addition to just like lower consumer interest. Now looking into 2015, we expect sales to be challenged as well. Not only do you have lower interest rates in the first quarter of the year, but you also have, with the implementation of AG 48, you have expected price increases within the universal life product. So with that said, we're going to look at the individual annuity segment. That actually had the largest area of growth. That business segment grew by $6 billion or 3% in 2014. That was driven by the increase in fixed index annuity sales. Traditional fixed annuities, lower crediting rates has led to a decrease in sales. Within variable annuities, it's a combination of two things. Actually, variable annuities have been declining in the last couple of years. More of a less of a risk appetite for the insurers to carry these products, and also less product features. More conservative funds, limited fund choices offered by the carriers has also contributed for that product having lower sales growth. Now, when we look at fixed index annuities, it's more of distributors carrying the product, in particular banks. So we've seen a tremendous amount of increase in bank sales within the fixed index annuity product over the last 18 months, and we expect that trend to continue. And the appeal of these fixed annuity products is for these baby boomers who maybe haven't saved enough. They want a guaranteed income stream going forward, and the fixed index annuity products helps manage that. Now, speaking with annuities, we're looking at the group annuity side. It's a little different story. It was down slightly in 2014, the amount of direct premiums within that business segment. But when we look at it, it was really attributed to funding agreements and guaranteed issued contracts. They were lower in 2014. Pension risk transfers helped offset most of that decrease within the year. AM Best thinks that the pension risk transfer line of business will be an opportunistic product going forward. But even with that said, the decreasing of premium within the group annuities, it's still the third largest contributor to total premiums within the U.S. health life industry. So it trails only ordinary life and individual annuity products.
The lower for longer scenario has been an ongoing headwind for the industry for a number of years now. Life insurance has seen a steadily decreasing trend in portfolio yields. There has been a general trend of trading credit risk for liquidity risk. Mortgage loans, for example, have increased steadily as a percentage of general account invested assets in recent years. Schedule BA assets, which include such securities as surplus notes, limited partnerships, private equity, and hedge funds, that has seen a more significant increase. Companies have also purchased bonds that have had generally longer average maturities, in which the overall average maturity in 2014 was about 10.8 years compared to 10.1 years in 2010. We would expect the life industry to look for opportunities when they arise, but also note that the competition for higher yielding assets is intense, with limited supply. Insurers will continue to invest in asset types such as private placement bonds, Schedule BA assets, mortgages, and structured securities, where they will gain additional yield, but they would also be considered less creditworthy, less liquid, and perhaps have longer durations.
We'd like to thank AM Best for their contribution to our program. If you'd like to see more of the First Monday series, visit the AM Best website.